Nest eggs aren't built overnight. They're built by small contributions and strategic planning. Your nest egg is complete when you reach financial freedom. This is when active income is replaced by passive income and your life's budget is funded. How you build your nest egg is up to you, but if you're looking for a foundational investment, consider the S&P 500 through a mutual fund or ETF. Investments, also called contributions, can grow in more than one way. The first is appreciation, which is the increase in value of your contributions over time. Appreciation is simply a percentage representing the average annual increase of an asset's value. This is known as the compound annual growth rate, or CAGR for short, a term you'll hear often with NestEggTools. Your investment contributions appreciate through a mathematical phenomenon called compound interest, which Albert Einstein expressed is the eighth wonder of the world. What makes it so powerful? Let's explore the formula for future value from yearly contributions and compounding interest. FV represents the future value of your investment after a number of years. SV is your starting value. If you don't have a starting investment, you get zero future value, because multiplying anything by zero is still zero. If you do have a starting amount, it's multiplied by 1 plus the compound annual growth rate, converted to a decimal, and raised to the power of the number of years you're investing. If you're making annual contributions, there's even more. The annual contribution amount is multiplied by the result of 1 plus the compound annual growth rate as a decimal, raised to the number of years, and subtracted by 1. That total is then divided by the CAGR to finish the compounding effect calculation of your contributions. The single most impactful contributor to growing future value in this formula is time. And here's why. Time is represented in the formula as an exponential function. As time increases, the effect of compounding accelerates upward. The best thing you can do is maximize your investment's time. The longer you stay invested, the greater the exponential effect. If you've played with an online compound interest calculator, you've seen this in action. If not, let's walk through an example now. First, enter your starting amount. Let's say $3,000. Next, enter how many years you plan to invest. We'll put 30 years in this example. Then, enter a rate of return as a percentage. This is the compound annual growth rate. We'll also include $7,000 as an annual contribution and set it to compounding annually. The result after 30 years? Your future value is $1,203,806. Here's the real kicker. Only $213,000 of that is from your contributions. The other $990,806? That's pure appreciation from compound interest. So, what does this tell us? To build your nest egg, you need three things: a starting investment, consistent yearly contributions, and most important, time. To make the planning process easier, we've built custom compound interest tables right into your net sheet. Let's jump into the Plan tab tool and show you how to use it. In the template, there are 8 user input title cells. These represent your financial goals or plans that you want to invest for. To start a plan, click on its row expansion button to reveal 2 dedicated portfolio plan tables. These tables are customized compound interest calculators designed for you and your partner. First, assign ownership to your table with the drop-down selection. This will update the owner's age in the secondary header row in column L, followed by the next 60 years grouped into decades. To input investment plans in your portfolio, click the row expansion button in the secondary header row. The template's default has space for 4 investments, but more can be added if needed. Each investment consists of a group of 3 rows which expand with their corresponding row expansion button. Columns A through F are all user inputs for the investment portfolio plan. In the header row of columns C and D, there are 2 user input cells for owner notes regarding the portfolio. For example, you can document a desired age range target in column C and a financial target in column D. Let's start by reproducing the result from the online calculator example. We said current investment is $3,000, so that is entered in the $start cell. Next, we plan to invest for 30 years. In the portfolio plan tables, this is set by entering two ages. The start age is typically your current age, unless you're planning a future investment. And the view age, which searches the table's 60-year span for the matching age and displays the ticker total result of the view age in column I. 30 years from age 32 is 62, so 62 is entered as the view age. Next, we use 10% as the rate of return, so that goes in the appreciation CAGR cell. Finally, we set $7,000 as the yearly contribution. Now we can see the investment's estimated future value at age 62 is $1,203,806, which matches the result from the online compound interest calculator. For a deeper look, click the expansion button above column F. Here you'll see a breakdown of the ticker total, which includes the starting value and yearly contributions combined, the appreciation total, representing how much the investment has grown, and the percentage of the ticker total that represents the start and yearly sum. In column I, the appreciation and dividends related to the entered view age are also displayed below the ticker total. But note, the values for appreciation and dividends are from the year prior to the view age. That's because each ticker total represents the amount at the beginning of the year, so the last received appreciation and dividends contributing to the view age's ticker total are from the year prior. Now let's explore the bonus features built into these portfolio plan tables. We'll start with organization. Each investment within a portfolio has 3 cells designated to organization labeling: sub-portfolio, ticker, and tag. In our example, we'll specify Roth IRA as the sub-portfolio. For the ticker, we'll plan on investing in the S&P 500 Mutual Fund, VFIAX, and finally, we'll add a descriptive tag for the investment. In this case, S&P 500. Next, let's introduce dividends, the second way investment contributions can grow. Dividends are payments made by a company or a fund to its shareholders. They're a portion of profits and serve as a bonus for continued ownership. When a company or fund experiences continued growth and success, those dividend payments often increase over time, accelerating your investment's growth. To include dividends in your portfolio plan, search online for the ticker's dividend yield and enter that percentage into the table. Next, include a dividend CAGR and update the appreciation CAGR for your ticker. When it comes to projecting long-term growth, it's critical to use a reliable growth rate. Benjamin Graham, in his book The Intelligent Investor, emphasized the importance of looking beyond short-term price fluctuations and focusing on past long-term growth performance. He suggests that investors compare the average earnings of the last 3 years to the average 10 years earlier. This method provides a more proven and realistic view of a company's growth. To help you determine a sustainable CAGR, we've built Graham's method right into your net sheet. Let's jump over to the CAGR Tab-Tool and review how to use it. The CAGR Tab-Tool is divided into 3 tables, each designed for a specific type of investment or compound annual growth rate. The first table is for mutual funds and ETFs. All you need is the ticker symbol, and the table will automatically populate with current and past prices. These prices reflect the net asset value, or NAV, which represents the value of each share in the fund. With historical NAV, the CAGR table calculates the compound annual growth rate, giving you a realistic expectation for its appreciation. Once you have the CAGR percentage for your ticker, you can apply it in your portfolio plan. The second table is specifically for stocks. Stocks can have larger price swings that don't always reflect business performance. This is why, following Graham's advice, it's best to use earnings per share instead of price to measure a stock's appreciation. For this table, you'll need to manually enter the last 3 years of EPS data, along with EPS data from 10 years prior. These values can be retrieved from the company's financial reports, or faster yet, requested from AI tools such as ChatGPT. The third table is for calculating dividend compound annual growth rate. This applies to all dividend-paying financial securities. Similar to above, the dividend table requires manual entries for each year. Let's collect dividend data for our example. Head over to Yahoo Finance and type in your ticker symbol. Next, click on Historical Data. Update the setting from historical prices to dividends only. Then expand the timeline to max. Take the most recent quarterly dividend and enter it into the table. Repeat the process, using the same quarter for each year in the table. Once entered, the CAGR table does the rest. Retrieve the dividend CAGR percentage for your ticker and use it in your portfolio plan. With dividend inputs entered in the portfolio plan, dividends will contribute towards your investment's totals. Column I, as mentioned before, will display the dividends received a year prior to the view age. To see the total amount of dividends received, observe column H. Use the checkbox in the table header to adjust your dividend reinvestment plan, or DRIP for short. When the box is checked, dividend reinvestments are included in your portfolio plan. Toggle the checkbox on and off to review the impact dividends have on your results. As additional investment line items are included in your plan, their individual results will roll up into the portfolio total in the header row of column I. Column G's header row provides the sum of all start and yearly contributions. Column H's header row provides the sum of all appreciation and dividends. If DRIP is off, column H header only sums appreciation. To evaluate potential tax implications, click on the expansion button above column I and enter your expected tax rate for the investment. In our example, the sub-portfolio, or account, is a Roth IRA, which is a tax-advantaged account. But if instead this was a brokerage account, appreciation and qualified dividends would be taxed at current long-term capital gain rates. It's important to understand the difference between how these are taxed. Dividends are taxed yearly as they are paid out. Therefore, the view age dividend tax shown represents the taxes owed for the dividends received the year prior. Appreciation is only taxed when you sell your shares. The capital gains tax shown represents the taxes owed for the total appreciation of the investment. To avoid a large tax bill, it's better to sell shares periodically rather than all in one year. The last bonus feature to reveal is the ability to control the timing of both contributions and distributions. Earlier we used $7,000 as the yearly contribution amount for the investment, but next to this, we can specify the age at which to stop yearly contributions. With our example being an IRA account, distributions can begin penalty-free at age 59.5 at the time of this video. Therefore, we'll set the stop contributions age to 59. Below contributions, you can also add a yearly distribution and start age. Distribution refers to a payment to yourself from selling shares of your investment to fund your budget. Let's say you want to live off $150,000 per year from your nest egg, starting at age 60. To verify whether your plan is sustainable, scroll through the year columns to see an approximation for what age your investment will last you. When the table balance turns negative, that means your portfolio is out of money. Determine based on your life circumstances how long you would like to live off of your budgeted distribution, as well as what extra funds you want left over, if any. In our example, to avoid depleting the account balance around age 77, we can try reducing the yearly distribution to $130,000. With this adjustment, we still have over $400,000 in our portfolio at age 91. An alternative way to extend the account balance without changing the contribution plan is to delay the distribution start age. While using this tab tool, it might look like investments only grow. But that's just how compound annual growth rates work. They show the average pace over time and hide the roller coaster of real cyclical market behavior. That's why learning about market cycles is key to becoming a confident investor. Market cycles consist of three distinct periods. Periods of consistent economic growth will raise investment values to the point of unsustainable optimism. These periods are called bull markets and eventually end with a peak value. A peak becomes official if the subsequent decline's value falls 20% or more from the peak. The time between the peak date and the trough's bottom is defined as a bear market. Following a bear market is a recovery period. These begin at the market bottom and end when the market fully rebounds to its prior peak, ending the cycle and starting a new bull market. One of the best ways to better understand these market cycles is studying the benchmark you're already familiar with, the S&P 500. Let's jump into the S&P Tab-Tool. This tool enables you to track market cycles over time for more strategic decision-making. Bear markets often lead to unjustified pessimism, creating bargains in the securities market. These are your perfect buying opportunities for optimized long-term gains, which increase your financial freedom time. To track market cycles, use columns A, E, and I to document each cycle's peak date, bottom date, and recovery date respectively. The template comes preloaded with data dating back when the S&P 500 was formally introduced in its current form. In the header row, you'll see the S&P index's current value. If the latest date in the table is a peak date, the current value will appear above the green bull market segment. However, if the latest date is a bottom date, the current value will show up above the red bear market segment. Next to the current value, you'll see the percent change from the value of the latest documented date in the table. If we're in a bull market and the S&P closing value's percent change has turned from negative to positive, it signals a new all-time high, meaning the previous peak date should be replaced. When the S&P falls to negative 20% or more, a bear market is confirmed. At that point, you should add the new bottom date to column E. During a bear market, this process works in reverse. When the S&P closes for the day and the current percent change turns from positive to negative, that signals a new bear market low, and the previous bottom date should be replaced. Once the S&P's value returns to or closes above the previous peak, the market has completed a cycle, and that recovery date gets entered in column I. Now that you've seen how to track each phase of a market cycle, let's look at the real payoff. Understanding how different bull and bear markets really are, and using this knowledge on bear markets to change your mindset from fear to excitement. Take a look at the columns for peak value and bottom value. You'll notice that for both, these values trend higher over time. Next to the value columns are the percent change columns, showing the total gain or loss for that portion of the cycle. Looking at the secondary header row, the average bull market ends with a gain of over 280% from the prior bear bottom, while the average bear market sees a decline of just over negative 34% from the previous peak. So while bear markets can trigger fear due to the perception of loss, this tool reminds us they're historically small relative to the next bull market. So don't panic and use them to your advantage. Documenting these cycle dates also provides the number of years a market cycle lasts. The average length, displayed in the secondary header, is just under 7 years. To break this down, click the column expansion buttons to reveal the average market lengths of each bull, bear, and recovery periods. These averages are used to project the future date of each market period for the current cycle. These dates are only to provide you context for whether you are in front of or behind the average timing of the market you're in. Familiarity with cycles is only part of the picture. To be a well-informed investor, you also need to understand the current economic environment. To do that, you can watch for the signals of the market before the headlines report it. This is where the History Tab tool comes in. It provides direct links to historical economic indicators such as the unemployment rate, inflation measured by the Core Personal Consumption Expenditures Price Index, or PCE, the federal funds interest rate, and the 10-year minus 2-year Treasury spread. Each of these indicate part of the economic story, which is driven by buyer and seller transactions using money and/or credit. The largest buyer and seller is the government. Made up of two parts, the central government collects taxes and spends money, while the Federal Reserve manages the economy's money supply and credit interest rates. The Federal Reserve, or Fed for short, makes decisions based on maximizing employment while keeping inflation under control. When unemployment increases, the Fed may lower interest rates to encourage more credit for transactions, which boosts the economy and spurs job creation. When interest rates cannot be lowered any further and the economy is still in decline, the Fed can print more money, a process called quantitative easing, which funds the economy to facilitate more transactions. But with more funds chasing the same amount of goods, inflation will rise, bringing up prices. When inflation rises faster than designed, it reduces the purchasing power of our money faster than intended. To fight this and reduce the rate of inflation, the Fed must slow the economy through limiting the amount of affordable credit by increasing interest rates. In addition to unemployment, another closely watched gauge of recession risk is the 10-year minus 2-year Treasury spread. When that spread turns negative, known as an inversion, it signals that investors expect slower growth ahead. And historically, an inverted yield curve has preceded nearly every U.S. recession. This tab serves as a tool for part of your monthly financial routine. Staying up to date with financial indicators enables awareness of potential upcoming headlines and having a plan for any situation. There's one last tab, the Calculator's Tab-Tool, a growing library of mini-tools designed for quick calculations to support your decisions within the other tabs. It's built to evolve, so when new calculators are developed, you will receive free access to each new and improved edition. In the description, click on our Tips and Tricks video playlist for a breakdown of each calculator in this tab tool and other helpful insights throughout your net sheet. Thank you for your time. This completes our Getting Started video series. The tools are ready. Learn from your numbers, plan for your goals, and adapt with confidence as you build the financial life you've earned and create the time you deserve.